Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Max Cabasso, Managing Director on Nasdaq's Market Intelligence Desk, for an update on technical levels to watch in the Nasdaq-100. And Max, September certainly living up to its reputation of being the most historical volatile month of the year. I mean, the trading activity that we've seen in this week alone has been quite substantial. So, when we take a look at our first chart here, what are some of the levels in the Nasdaq-100 you're paying attention to?
So we are bumping up against the upside resistance before yesterday's move, kind of getting close to that 12.5, 12.7 range, and then we broke yesterday. Now we're trying to hold this 12,000 level. I'm not sure it's going to hold. As you can see, I think we're probably going to end up. My guess would be testing those lows. I think 21 times the market has ended lower for the year. Only 4 times has that low been seen after the month of August, and I think 2 out of those 4 times we retested those lows and ended up holding. But again, most of the time where we see a market down for the year, the lows come in the back half, in the final quarter of the year. So I don't think we're out of the woods yet. So I think this first 12,000 level, and then 11.5 to 11, so kind of 500-point increments down to the lows of June, down to about 11,000.
Right, and of course the catalyst behind all of this is the inflation print that we saw yesterday that just created that flush. I think Nasdaq-100 down over 5% on the day.
Yeah, it was a bit of a surprising move given how, I guess, benign the data was. It was more, I guess, the reinforcement of Fed action that they're not going to back off. So obviously the rates went wild. Core piece is getting a bit stickier as expected. It's kind of been the same narrative though over and over. Okay, we've seen it peak, it's peaked, it's peaked. It started as transitory, then it was peak, and each time that's happened, we've kind of been hit, on that broadside. Wait, we didn't expect this, and then the Fed's coming in. We're not going to stop. So interest rates, the Fed's pricing in now. It's over at 75 basis points, but I think it's about a 30%, 35% chance of a 100 basis point move at the next meeting. Peak Fed fund rate is expected to be about 4.25%, before they start to slow down. So everybody's been talking about the pivot, but I don't think anybody's really expecting that now with, inflation staying, 8.3% year over year. And again, core sticking at 6.3%. So services are really driving, this number now. So that's going to be a bit tougher to bring down.
And of course, let's take a look at rates, not only what's happening with the 10-year, but of course mortgage rates as well, because that's really what is going to influence part of the economy here, especially with what's happening in housing. It really is predicated on, I feel like what you're seeing in housing, what you're seeing in employment, because it's still somewhat relatively strong compared to other parts of the economy.
Yeah, you're still seeing prices are coming down in most markets, but not huge. And again, mortgage rates now ticking up to new highs, just over, I think, 6.25% right now is levels we really haven't seen. Again, the odds of rate hikes continuing to climb, 4.25% is essentially priced in by the end of the year. So I don't think anybody's expected to cool off. So we really need to see that, the housing market start to come in and those unemployment figures start to pick up. There's kind of what the Fed is looking for. Obviously, we don't want that, but that's kind of what they're looking for, to signal some sort of pivot.
Yeah, I mean, rates are over 6%, as we can see on this chart here.
6.25.
I mean, think about that. Even from last year alone, it's doubled, just about doubled.
Just about double. I mean, I think it was mid last year,
2.8ish, somewhere around
2.8, refi below 3%. Now we're up at 6.25 is the average rate, and I think the monitor is every percent mortgage rate takes away to about 10% of your buying power in terms of your pricing of what you can afford. So what you could afford last year, take about 30% off of that. So $1 million house you could afford, you're down about 700,000 is what you could afford for your monthly payment. So as this continues to go up, buyers, there's more equity. Buyers have more equity in their homes, but so I don't know if we'll see a drastic change like we saw in like 2008. Right. But again, that is going to impact buyers in the housing market, which obviously feeds into.
Well, I mean, part of the issue is there's no supply, and I believe it was yesterday CNBC had reported that 90% of mortgages are under 5%.
Yep.
Right. So it's really hard to go from a rate as attractive to that than to 6.25. So it feels like there's this bottleneck, and there's no alleviation for it on either side.
Absolutely. If you're sitting on a mortgage right now, like you said, below 5%, most below 3%, some, you're really not incentivized to go out and pay up for a house because then there's limited supply, so you probably still have to pay up. And you're sitting at a rate that's 3% when you're looking at over 6% potentially. You say, wait a second, well, I'm getting way less for my buck right now, and I'm sitting on a great rate. I'm just going to sit and kind of hold and wait this out before putting my house on the market and thinking about selling. Because again, I'm doubling my payment essentially for the same price, right? Your interest rate is double from what you were paying. So again, really not much of incentive to list and move. You know, I've it's more anecdotal, but having conversations, I've heard a lot more people that are either putting on additions to their houses versus going out and buying something new if they need more space. You know, okay, I'm just going to put an addition on or refinance up. You're not going to go out and buy a new house if you're sitting on a 3% mortgage and you'd go out right now at 6%. It just doesn't really make sense. So I don't see that supply really picking up in that.
I mean, it feels like the rates, just because they're hiked, it doesn't mean that things get fixed the next day. I think investors are going to have to be incredibly patient with this market. You're looking at least 12 to 18 months, and these bottlenecks are going to exist until the rates funnel itself through the system, because you have to start thinking about, you know, banks and mortgage lenders. You know, a lot of money is made in the mortgage and refi market.
Absolutely. And like you said, it's not overnight. Just because the Fed's going to raise, let's say they go 75, you know, at the next meeting, you're not going to see everything get fixed. Inflation's not going to come off. It's going to be a 9 to 12 month process where you see these rates really start to take an effect. So yeah, it's not going to change overnight. You really do have to be patient and wait for it to turn. And all the data it's always backwards looking. So it takes longer and longer to get out. So yeah, I think it might be a rough ride for the next 9 to 12 months and even 18 months. But that's kind of what we're going to have to do, because again, all the signs are pointing to longer term. This isn't something that, the Fed's not coming to our savior this time. Everybody's so conditioned to, okay, the Fed's going to help, the Fed's going to backstop, the Fed's here for us. The saying has always been, don't fight the Fed, don't fight the Fed. Well, now you can say the same thing. Don't fight the Fed. The Fed's going the other way at this point. So yeah, don't fight them, but they're looking for the downside.
And I'm so glad you brought that point up, because for at least the past 10 years, we have a generation of traders and investors who've only seen, up and to the right?
Yep.
And when you see headlines or there's this narrative in the market, these are unusual markets. This is not normal. This is, extra volatile, whatever you want to say. But I think when you use those terms, not normal and unusual, well, guess what? The past 10 years weren't necessarily normal either. That was an anomaly. Markets are supposed to go up and down.
Yep.
Economic cycles, including recession and troughs, and the move higher. These things are all supposed to happen. So I think it's almost like a retraining of investor psyche out there.
Yeah, for sure. Again, low rates, zero interest rate policy has kind of fueled that. The only thing I would say that is maybe different than historical norms is maybe the correlations. But again, markets do go down. Fed does have to raise rates. So my generation is not used to seeing a raising rate environment and how to trade that and what a real bear market looks like. The correlation chart of the S&P previously from 2008 and kind of how we looked and bear market rallies looks very similar. So again, we have seen it in the past. Maybe correlations are different just given what's happening in Europe and the strength of the dollar. But it is, there are historical precedents of bear markets. So it's not always a bull market. We've been in the longest one, I think, ever. So we need to retrain our brains that, we're not always going to, break new highs every 3 months, just buy every single dip. That's
right. Well, you know what, though? It's good that it's happening now while you're really young in your career and also in your lifespan. So good opportunity to pick up some pretty incredible deals here, because when you look 30, 40 years out as a long-term investor, these bear markets do pay off. All right, Max, appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.